When we talk about structuring the loan,
Yeah.
you have three main components, and then there's some fringe kind of back end stuff. But your three main components are down payment, amortization, and interest rate. Those are the three things that we're really going to focus on.
Yeah.
They're interrelated. So they're levers that you can pull. If I want to drive my interest rate down, I can put more cash down.
Yeah. Okay.
Keep the amortization. For those that don't know the word amortization, because it's a financy term.
Sure.
If you think about your home loan, you have a 30-year home loan. Well, home loans are calculated as 30-year term, 30-year amortization.
Right.
So my monthly payment is as if I have a 30-year, but I can hold it for 30 years. Airplane transactions are typically structured in a 5-year term and an amortization period that is longer than that. So there's a balloon payment at the end of the 5 years.
Okay.
It's a commercial lending regulation. There's a whole reason why that is the case, but that is typically how they're structured. So when I talk about amortization, I'm going to pay as if it was a 15-year loan, but at the end of the 60th month, the fifth year, I will have the outstanding balance will come due.
Gotcha.
So that's the end of the term. So when I talk about amortization, that's just so that everybody's kind of on the same playing field. So down payment, amortization, and then interest rate. Those are the three levers. So if you want a lower interest rate, shorten up your amortization, or raise your down payment. Interest rate is calculated based off of risk of not repaying. At the end of the day, the bank needs a yield on their money. So if you're more risky, your interest rate will be higher. They will require a larger down payment. And the down payment amortization has to do with if the bank has to go pick it up. The bank does not want that airplane back.
Right.
Period.
Right.
I don't know if you've ever had a client go default, but it's really rare.
Yeah.
The bank is going to try and work with you. But amortization, it depends on what equity position you're in the aircraft, and it is what determines a lot of your monthly payment. And so if you want a longer amortization, you may have to come with another 5 or 10% down. Or you may have to pay another 25 or 50 basis points a quarter to a half point of interest in order to get that longer amortization. So we can play with those three levers depending on what your priorities are. So if you're saying my cost of capital, which is a fancy way of saying interest rate, is the most important thing, well, maybe we'll come in with another 5% down, shorten the amortization by 3 years, and we can maybe drive that down by 50 basis points, a half a percentage. Maybe that's important to you. Maybe you're a cash flow guy and you say, I want the lowest possible monthly payment. So maybe we'll pay a little bit more in interest, but we're going to kick the amortization out as long as we can and have as little money down. So it's those three things really interplay with each other when you're talking about structuring a loan.
Makes total sense.